Wow, what a day! Trading was halted across many of the CME markets. Whether this is the issue or not, it doesn't really matter. I'll show you later. All the silver people came out and said it's silver that broke the system. They shut all of this down because silver is out of control. This was an exciting day, and there's some other things. Silver has basically done a breakout. We are over 3% above the previous highs here, and that is confirmation of a breakout. So now it's sort of free to run, and it looks like it is. History is repeating, and it is interesting that this breakout is coming on approximately the same day. We may be off to the races, so it's possible by next January we could be seeing some very, very high prices in silver.
The precious metals landscape is currently undergoing a historic shift, with silver surging past $56 per ounce to hit fresh record highs amid a fifth consecutive year of structural supply deficits. Major financial institutions like Bank of America and Goldman Sachs have raised their outlooks, now forecasting gold could reach $5,000 by 2026, driven by relentless central bank accumulation and debasement trades against fiscal instability. With solar demand intensifying the silver shortage, the market is primed for what analysts are calling a perfect storm of bullish drivers leading into the new year. In this video, MikeMaloney, best-selling author and founder of GoldAndSilver.com, dissects the chaotic CME trading halt blamed on data center cooling issues, questioning if it masked a systemic break caused by silver volatility. Maloney highlights a confirmed technical breakout where silver pushed 3% above previous highs to 56.53, drawing a striking parallel to the 1979 and 1980 bull market run-up. He suggests this momentum signals we are off to the races, potentially seeing exponential price appreciation by next January as history repeats itself. Let's watch clips from MikeMaloney's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Wow, what a day! Trading was halted across many of the CME markets. This is a Chicago Mercantile Exchange. This includes futures, derivatives, currencies, and gold and silver. And right away after this happened, whether this is the issue or not, it doesn't really matter. I'll show you later. All the silver people came out and said it's silver that broke the system. They shut all of this down because silver is out of control. And that is a reasonable possibility. We've got very, very low stocks in London and so on. The supply-demand fundamentals for all of this is, so it was blamed on a cooling issue, that this data center had exceeded its capacity to cool. Now, there's some good evidence that may be the truth, but I'm going to show you later that it does not matter. But this was an exciting day, and there's some other things. Silver has basically done a breakout, so you need to watch this to the end. All of the silver people came out and immediately attributed it to silver breaking the system instead of the system just breaking. Shanaka says that it wasn't the silver breaking the market. It wasn't a cyber attack. It was basically that. And by the way, 90% of global derivatives trading stopped. Not hacked, not manipulated. The cooling system failed in a single data center in Illinois. But this is the tweet that I would like you to read. It is long. Silver's bull run hit a CME circuit breaker, but the cycle won't stop. And basically, Ben Rickard is putting out the evidence here of why this cycle won't stop. And the great part is down at the end here. He says, money is unraveling. He means currency here. Money is unraveling. Confidence is eroding. Price signals are returning. And silver, which is money, is the underestimated monetary metal. Monetary means money, is leading the way. The bull run didn't pause. The exchange did. That tells you everything you need to know about where this cycle is going. And he has nailed it here. In looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. But if you look at this, the orange line is the 50-day moving average. And look at the support that it has given this all the way across. The green line is the 10-day moving average. And the 10-day moving average, you'll notice on uptrends like this, that it gives great support on uptrends. And when it breaks it, we're in a little pullback. It's given great support. Now, every once in a while, gold and silver and almost everything else in the markets needs to come back and visit its 200-day moving average. But that is a much more rare event. So we've visited the 50-day 3 times here. We've visited the 50-day. It's worked off its overbought condition. So now it's sort of free to run. And it looks like it is. We've done a breakout. And this is we are over 3% above the previous highs here. And that is confirmation of a breakout. Here it is on my own website, GoldSilver.com, 56.53. And then the main point, though, isn't to pay attention to all of the short-term noise. Yes, some servers probably overheated. It probably wasn't silver breaking the market, but I don't know that. I can't confirm it. Maybe it was silver, and maybe this is all an excuse. I doubt it. But keep an eye on the big picture. In September, I drew you these charts. This is the big 45-year cup and handle pattern that I believe I was the first one to identify, but it hadn't broken this yet and confirmed that we were off to the races. Here it is in linear format instead of log, just to show. This is the big old beer stein. Cheers. But in keeping an eye on the big picture, I want to compare this to the 70s bull market. So here you've got 1979. The last year of the 70s bull market, because it ended January 18th, 1980. So this is to January 19th, 1980. And it was 49.45, all of these because Stock Charts doesn't have the intraday data, but that was the close. It actually reached 52.50 intraday. But if you look at what's going on here, it was rising and rising and rising. Now, the Hunt brothers had a major concentration in the silver market. And it is my total belief that because the Federal Reserve was involved in some of these decisions, Paul Volcker, but it is my belief that that gold was in a runaway, and that threatens the survival of the dollar. The dollar had only been a fiat currency for 8.5 years. And they were trying to get gold under control. But gold is a huge market. It takes a lot. Now, in the silver market, it was I don't know the exact size back then, but it was around 1/300th of the size of the gold market, something like that. There are times, though, where it's only like 1/30th of the gold market instead of 1/300th. It was much easier to control. And then the Hunt brothers had a major concentration. So they had basically a scapegoat, and they had somebody that had a major concentrated position that they could break if they kept on changing the rules. So they went up and they kept on increasing margin requirements and increasing margin requirements. But still, it did a breakout. So here we have roughly $6 at the beginning of 79. And then we've got 1750, higher than 1750 here in September. And then at the end of November, just like today, this is, what was that, 43 years ago, something like that. It did a breakout and started a run. And they would increase margin requirements and increase margin requirements. And then they put in position limits. A futures contract is 5,000 ounces. They put in a position. You could only hold so many futures contracts. And that caused major players that have very large positions to have to dump a whole bunch of their silver. But that didn't stop it. And it kept on running and running and running. And then they finally had to put in a rule, liquidation orders only. Now, we haven't started any of this shenanigans yet, so the people that make the rules of the game were short silver, and something had to be done, but also gold was in a runaway, and we came very close to losing the US dollar back in January of 1980. And so if you can crush the silver, a whole bunch of people that trade silver also trade gold. All of the brokers that do gold and silver trades do both. In the commodities exchange back then in Chicago, in the Chicago Mercantile Exchange, there were pits, circles of guys doing hand signals and screaming at one another and doing all of this trading. And the silver pit is right next to the gold pit. And don't you think, like on a bathroom break or something, they talk to each other? And don't you think that the gold guys go, wow, if they can do that to silver, we're next. And gold and silver peaked on the same day. They put in a rule called liquidation orders only on silver, and that is a rule that says until this rule is lifted, the price of silver can only go down. It means that you can close out existing futures contracts, but you cannot buy a new futures contracts. If there are no buyers and all you've got is sellers closing out old deals, that means the price has to fall, period. And so this is a rule that says until this rule is lifted, the price must fall. And don't you think the gold traders go, oh my God, we're next? And they all said, sell. And that's when gold and silver peaked and the dollar survived. Now, history is repeating, and it is interesting that this breakout is coming on approximately the same day, 40 some years later, as it did back in November of 79. And we may be off to the races. So it's possible by next January we could be seeing some very, very high prices in silver. But to account for the expansion of the currency supply, to account for the growth in GDP, perhaps we need to move this decimal one place to the right.
Ultimately, market participants should look past the headlines regarding the CME cooling failure and focus on the charts, as price action is the only truth. With silver confirming a decisive technical breakout, 3% above previous highs, and successfully testing support at the 10-day and 50-day moving averages, the technicals scream bullish continuation. This rupture of the 45-year cup and handle pattern signals that, much like the 1980 run, the metal is now off to the races and primed for significantly higher targets by January, regardless of exchange disruptions. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.